Hello, I'm Natalie MacDonald and you're watching Dukascopy TV. In today's UK news, GDP contracted by 0.3% in the final quarter of 2012, prompting fears Britain could be on course for its third recession in 4 years. On the phone with me now is Daniel Murray, Chief Economist at EFG Asset Management. Hi Daniel. Now, while this data did undershoot official forecasts, how surprised will the markets really be by this figure?
I think it'll be more of a disappointment rather than a great surprise. I'd note a few things in that regard. First of all, this is only an estimate anyway, and it's a very early estimate. So there's opportunity for this number to be revised. It may be revised down, but it could equally as well be revised up. So it's only really a first draft of where fourth quarter GDP was. The second thing I'd note is that the NIESR, which is an independent private organisation in the UK, produces anyway a monthly estimate of GDP, which is very highly regarded. That was released a couple of weeks ago for the fourth quarter, and that estimated GDP is contracted by 0.3%, which is bang in line with the actual release of data. So I don't think it's a massive surprise to markets, and indeed, as we see markets trade in the sort of the brief period after the release, there's been a massive amount of movement.
Is the UK on course for a triple-dip recession, do you believe? And if so, how will this shape the current debate surrounding Britain's exit from the EU?
I think clearly the risks have gone up that we'll see a triple-dip recession. It's rather a technical factor anyway, because whether or not the economy expanded by a small amount or contracted by a small amount is really largely just a function of the underlying components of GDP. So it's rather a technical issue as to whether or not it's a triple-dip recession or we marginally miss a triple-dip recession. I think in terms of the EU debate on whether or not Britain will leave, it will clearly have a short-term impact. But I think we need to remember a couple of things. First of all, the polls suggest that if we were to have a referendum tomorrow, that the vote would be in support of Britain leaving the euro, and this data would probably add weight to that. But remember, the vote, if one takes place, is not going to occur for several years. So there's an awful lot of water to go under the bridge before that vote takes place. So I don't think today's data in itself is going to massively shape the debate. It's just another piece of information that will help people make decisions.
The IMF cut Britain's growth forecast this week to 1% and has repeatedly urged Britain to take stock of its policy framework if growth did not improve. With several key figures, including Bank of England Governor Mervyn King critical of the UK's current austerity policy, what is next?
It's a very difficult situation because so much of the fiscal position is cyclical, because when growth is strong, obviously needs are higher and expenditures tend to be lower because things like unemployment benefit, the expenditure on that is reduced. So it's a very difficult situation, and it's a little bit chicken and egg in that the Chancellor needs growth to get going in order to improve the fiscal situation, but he needs to improve the fiscal situation in order that we don't experience a more severe debt crisis. So it's a very hard mixture of policy to get right. History suggests that the weight in terms of fiscal consolidation should be put on expenditure cuts, which the Chancellor has done, and that less should be put on taxation, and that, that's the pattern that's followed. But I don't think the Chancellor has an awful lot left up his sleeve. He said that in Davos this week that he wouldn't change his stance if the GDP data was weaker. So I think, as he said before, there's no plan B. The Bank of England, on the other hand, has suggested that there's a bit more room for them to more stimulus. And I would imagine that if we get another quarter or two of pretty weak data coming out of the UK, then the Bank of England will add a bit more stimulus. Whether or not that will work or not is questionable, but I think it's about the only thing that, from a policy stimulus perspective, that they're capable of doing.
The sterling was cautious ahead of today's data, with the events of this week weighing on the British pound. What is your outlook for the pound for 2013?
Yeah, we've seen sterling come off a little bit. I think the outlook is, from a fundamental basis anyway, that sterling should be a little bit weaker than it is today. That's really just based on the observation that growth is weak, that central bank balance sheet has expanded quite rapidly. Obviously, Britain runs quite a large current account deficit, all of which would tend to put downward pressure on sterling. But I don't think sterling is massively out of kilter with its fundamental fair value. Probably, maybe something like 5% away from what's technically its fair value. But of course, currencies do move around a lot more than the fundamentals would suggest. I think what has sort of kept sterling a bit stronger than perhaps fundamentals might suggest is the fact that it has its safe haven status, and so there's been a lot of money flowing into sterling bonds because obviously still AAA rated just about, and that's been helpful. And also the fact that weaker data will increase the probability that the Bank of England does more stimulus, and that's going to help to keep bond yields low, which in turn would tend to act as a weakener for sterling. There's, I don't think massive implication, but it's certainly at the margin expect sterling to get a little weaker. I think, if we view sterling in an international context, which of course we must, really what's been described by myself and others as something of an ugly contest. So most of the world's currencies are looking pretty weak from a fundamental perspective. We're not quite in full-blown currency wars yet, as some people might have you believe, but it's just a question of a choice between weak alternatives.
Daniel, thanks very much. I'll be back on Monday with an in-depth look at Israel's central bank rate decision, but for now, goodbye and have a great weekend.